Hello, everyone. Welcome you to Developing Markets Society. And it's also my pleasure to welcome Marcelo Carvalho from BNP Trading. He is the head of the Emerging Markets Division, and he's here to give a presentation on various things, including the threats facing us today, the threats facing emerging markets today, inflation, interest rates. And it's my pleasure to welcome him here, and I'm pretty sure he'll give a fantastic presentation. So without further ado, Marcelo.
Thank you very much. Fantastic presentation. I see the bar is set very high, so I can deliver. But let me start by saying thank you very much for the invitation. It's a pleasure for me to be here. I understand it's reading week, so the fact that you're here in this room today says a lot about how engaged you are with the topic. So thanks for attending. Also, congratulations on the building. I understand it's brand new, really fancy, looks very nice. I almost didn't come up because on the way here, there was a nice gym downstairs, so I almost stayed there. So well done on the building as well. Okay, I think the idea is to have a frank and informal conversation. I brought some slides just to avoid you falling to sleep. So I'll show a few things here, speak for a while. But then let's make interactive with questions and answers. And I always say this, you can ask anything. Because if I know the answer, I'll tell you the answer. If I don't know the answer, I'll come up with something anyway. So you can ask anything really. All right, I thought maybe even before I go into the presentation about the outlook for emerging markets, maybe I can share a few comments about my own career, how I got so far. Maybe it's useful for you guys, your school, think about your careers, perhaps it helps. And also I like to do it because then I talk about the past, which is much easier than talk about the future, the outlook for emerging markets. I mean, making forecasts is very hard, especially making forecasts about the future. Forecasting the past is much easier. So let me start with the past very briefly. So I'm Marcelo Carvalho, I'm now head of emerging markets at BNP Paribas. And I'm originally from Brazil. That's why I started my studies, did the undergrad in economics. Some of you are doing that as well, I think. Then I did the master's in Brazil as well. And I didn't know what to do other than to keep studying. So I went to do the PhD in the United States as well. And then the PhD was over. I didn't have anything else to do, so I had to start working eventually. So that's what I did. Then I joined JP Morgan to be the chief Brazil economist, back to Brazil to work for JP Morgan for many years. After that, I went back to the United States to work for the IMF, the International Monetary Fund, for a few years, Washington, D.C. That was fun, because then I was actually part of the IMF team that would travel to Brazil for the discussions with the authorities. But then I was sitting on the other side of the table, right? Speaking with the Brazilians, but from the point of view of the IMF. That was very interesting. And you see also how it works within the fund. There's a lot of politics going on, much more than I thought before. So after the IMF, I went back to Brazil, joined Morgan Stanley for a few years, covering Brazil and Latin America, and then joined BNP like 11, 12 years ago, to be the chief economist for Latin America, based in São Paulo. So that was until some 3-4 years ago, when they got fed up with me, and then they shipped me over to London. They sent me into exile. So I moved here to be the head of emerging markets. They promised me that the weather was going to be fantastic. Not sure about that, but here I am. So that's my story in a nutshell. Let me then move on and tell you a little bit about emerging markets, which is my focus. And maybe I should start by briefly telling what you're talking about here. I mean, what's emerging markets, right? And let me tell you first what emerging market is not. Of course, emerging market is not an advanced economy as the US or the Eurozone or Japan or Canada or the UK. Although sometimes people say, well, maybe the UK should be reclassified as emerging market. I refuse to welcome UK into the group. So there is the advanced economies, that's not emerging markets. And also there is the maybe really poor economies like sub-Saharan Africa which from a market's point of view isn't really considered emerging markets. It's more of an exotic country, frontier economy. So emerging markets are kind of in between, middle income kind of countries in Latin America, most of the guys from Mexico all the way to Chile. In Africa, a few countries, South Africa is clearly an emerging markets, a market, but not so much the others. And then most of Asia. China is interesting. China, there's an ongoing debate whether it should be still considered emerging markets or whether it has emerged already. So these emerging markets. Let me tell you about the outlook here, focusing on growth, focusing on inflation, what happens to interest rates going forward, what happens to the fiscal accounts, and I'll be brief so I can shut up and we can have some questions. So let me start with this chart on the right-hand side, which shows in more perspective the role of emerging markets in the global economy, not only now, but in years to come. So what you have here, to begin with, is the beginning at the start of the century, or the millennium, I should say, the role of the US as a share of the global economy, so share of total GDP. So the US was about 25% of the global economy. Then you have the Eurozone, which is another 15–20% of the global economy, other advanced economies, Canada, UK, and so on, and then China, and then other emerging markets, everybody else. So that was the picture back at the beginning of the century. Now going forward, this chart gives you some projection from the IMF, OECD, and BNP, going all the way to the next several decades. So I like this chart because it shows what we should expect going forward in terms of the changing weights, the changing participation of each of these regions in the global economy. And one thing that should be very clear is that when you put together the US, Eurozone, and other advanced economies, their share in the global economy should be shrinking relative to where it started. By contrast, what should be growing dramatically actually is the share of emerging markets, including China and other emerging markets. So I'm showing this chart to try to convince you that emerging markets matter and should matter increasingly over the next several decades. That's at least what I tell my boss when I ask for more budget resources. The market's a big deal, but I believe that's indeed where we're headed. Now, shifting to more of the regional composition of growth, this is a different chart. Here on the left, I'm showing average real GDP growth, showing 3 regions to illustrate that not all emerging markets are created equal. There's a lot of divergence, dispersion, differentiation, I should say, within emerging markets. So if you look at the blue line, it's emerging Asia, which historically has been growing faster than other regions. And then the green line is what we call CEMEA. CEMEA stands for Central and Eastern Europe, Middle East, and Africa. So basically the guys that are more or less in our time zone. And then we have LATAM, which stands for Latin America, right? LATAM. So there's some movement. Sometimes they move together, particularly if there are big crises, like recently, of course, with COVID, everybody came down. But there's also dispersion in the sense that not always these guys move together. There is a lot of idiosyncratic factors that differentiate them. So just think in terms of a portfolio, right? If you want to diversify your bets, look at emerging markets as a whole, gives you more diversification than betting in just one single region or country. There's much more that we could go in detail here. It's impressive how Latin America in particular has been underperforming recently, in part because of Argentina, in part because of Brazil, but maybe I can save that for the Q&A. So this is the growth outlook. Long-term message here, long-term emerging markets are going to be increasingly more important, but in the meantime, we're going to see differentiation across regions. And that's Luis Peixoto that just arrived. He's our emerging market economist at BNP Paribas. He works in my team. He's really the brains. I'm just the pretty face of the team. So let's move on from growth to inflation. And I was talking here before about inflation in Latin America. This chart here, I think, is interesting. It shows inflation in three main regions of emerging markets, as I said before: Latin America, CEMEA, and emerging Asia. Sometimes people call APEC, which is Asia Pacific. It's the same thing. A few things in this chart. I mean, first is that you see how back in the 90s, we really had very high inflation in places like CEMEA and LATAM, really high inflation. If you go back to the 80s, I mean, I'm from Brazil, as I said, I remember when inflation used to be 10%, 20%, 30%, not per year, but per month. So that's really high inflation, right? We came a long way. So central banks gained flexibility. Many of these guys introduced inflation targeting regimes. They built their track record and they managed to bring inflation down to single digits, pretty much. I mean, less than 10%. Most of these guys. There are still exceptions today. Argentina is one, inflation like 50%. Turkey is another one where you have double-digit inflation. But big picture here, broadly speaking, emerging markets have advanced a lot over the last 2-3 decades in bringing inflation down. That being said, if you zoom in here, I mean, I'm talking about numbers since the 90s, right? If you zoom in here, you can see this big jump. Not so much in emerging Asia, where inflation is still fairly low for now, but in CEMEA, in Latin America, big jump. This is really global. It happens right now in the United States. It happens right now here in the UK, as you know, 5.5% inflation. In the US, it's more than 7 already. There are global factors behind this, but emerging markets are not an exception. Inflation, although much lower than before, clearly are jumping. And that's what is forcing many central banks already to hike interest rates across emerging markets. I mentioned inflation targeting as a new tool or a new regime that emerging markets are using. And this illustrates across countries what the targets look like. So it's mostly around 3%, the target for inflation. I mean, some guys have 2%, some of them have 3, some have 4, 4.5. Egypt is an exception here. And then the bar shows the tolerance range. It's usually 1 or 2 percentage points either way around the target tolerance range. By the way, the UK was one of the first ones. Bank of England was one of the first central banks to introduce inflation targeting regime after New Zealand. Brazil, in particular, copied the model that was used here in the UK. All right, so that's it for inflation. So bottom line, we came a long way. However, right now there are pressures building in inflation globally and in emerging markets as well. So no wonder that central banks are responding by hiking interest rates. Let's look at the chart at the left. Let's start with the Fed. So this is the policy, the benchmark policy rate, the federal Fed funds rate in the US. The central bank in the US brought rates to close to zero, kept them there for a while, long period of time. We had a hiking cycle here a few years ago, then COVID came and rates were slashed close to zero. Not to mention so-called quantitative easing, which is something that goes even beyond the short-term policy rates. And then the dotted line shows what to expect going forward. The Fed's going to hike rates. And that was actually a big story now in January, because inflation has been surprised to the upside, and the markets are quickly revising what they expect for the Fed. So a few months ago, people thought, well, the Fed's going to hike very gradually, there's no rush. And now people are saying, well, you know what, we have to do more than we thought before, given the pressures on inflation, right? 7.5% of inflation. This is much more than the 2% target that the Fed said it was going to pursue. So rate hikes are coming for the Fed, and rate hikes are coming already for other central banks in emerging markets. So again, I have 3 lines showing average policy rates in 3 different regions for emerging markets, one for Latin America, the other for CEMEA, the other for APEC. Latin America has been hiking rates aggressively already, and there's more to come. Countries in CEMEA, Poland, Czech Republic, Hungary, South Africa, all these guys are hiking rates as well. Russia, I should say, and there's more to come. The countries in Asia are still lagging behind. Inflation there is not so much of a problem right now, but even then, I think we will be hiking rates in coming months and quarters. Eventually, things turn around. Eventually, Latin America will be cutting rates. Eventually, countries in CEMEA will be cutting rates, but that's a story for next year, really. So for coming months, the story will be higher rates, certainly by the Fed, certainly across emerging markets. And I think when I look at this picture and when I look at what central banks say, let me take a seat because I'm getting old for these things. I do think that maybe I should have studied psychology rather than economics. And I'll tell you what. I'll tell you why. Central banks usually go through 3 stages of inflation grief. You know, psychologists talk about the 7 stages of grief. And something bad happens, and first stage is denial, and then you move on. Well, the central banks is the same thing. The first stage, and all of them go through the same processes, including the Fed. The first stage is denial. So they say, not a problem, don't worry, be happy. Inflation is just transitory. This is just a near-term change in relative prices. Core inflation is fine. I mean, core inflation is usually defined as everything that's not going up. If you exclude everything that goes up, inflation is fine. The central bank is going to say inflation expectations are well anchored, whatever that means. So they basically are in denial. That's the first stage, including the Fed. But then inflation keeps surprise to the upside. So we have to move on to the second stage, which is reluctant acceptance. They have to accept that, look, there's something funny here, there's something rotten in the state of inflation land, and they have to do something. They have to wake up and smell the coffee. In some places, it was good coffee, by the way, like Colombia or Brazil. Unfortunately, US, you have to be happy with Starbucks. But anyway, you move on to the second stage. You're still not really hiking rates dramatically, because you're starting to admit that something's wrong, but you don't fully acknowledge the full thing. And then eventually, you really have to deliver. And that's, I think, where we are now with the Fed. In March, in a few weeks, they're going to hike interest rates. It's going to be the start of what I think could be a very significant hiking cycle of at least a few percentage points, maybe quite a few. And with the Fed, what I find interesting is that maybe we should not just look at math, but maybe we should study some literature to understand the Fed. And this is what I mean. I think it was Ernest Hemingway in The Sun Also Rises that has a brilliant dialogue. This is the context here. So in this novel, there is a character that goes bankrupt. And then his friend asks, how did you go bankrupt? And then the guy says, well, gradually, then suddenly. Which is exactly what's happening with the Fed, I think. Because not until long ago, everybody said, well, the Fed is no rush, they'll be hiking rates very gradually. And all of a sudden, inflation is a much bigger problem. And then the Fed has to move much faster than people thought. So gradually, then suddenly is another way of saying, in financial markets, many times things are non-linear, right? Things take a lot longer to take place, but when they happen much faster than thought. And that's, I think, what's happening with the Fed, and that's what has happened already with emerging markets. All these guys that are hiking rates already were pushed to do it because in emerging markets, unlike with the Fed, you have less policy credibility. So if inflation is picking up, you have already to do something about it sooner rather than later. Because in emerging markets, inflation expectations are not as well anchored. I mean, if you don't do something, easily you can get a vicious cycle in which wages are going up, prices are going up, and then everything goes out of control much faster. That's why emerging markets have been ahead of the game in hiking rates. That's why when you look at this chart here on the right, you see this buffer building between emerging markets and the Fed, right? If you look at the difference between rates in emerging markets on average and the federal Fed funds rate, there is a big jump here that will be narrowed as the Fed hikes. It gives us some cushion, I think, for Fed hiking in emerging markets, but it also illustrates how emerging markets had to be ahead of the game and hike. Okay, so that's inflation. What's this one here? This is about the external accounts or fiscal accounts. Okay, yeah, let's talk about this one. And Luis is the one that put this chart together, so I have to look and figure out what I should say about the chart. Okay, this one on the left, I think it's interesting too, because it shows the level of debt, total debt, as a share of GDP for several regions across the world. And it illustrates how all these numbers have jumped high. And that's because of COVID. I think that's interesting as well, because around the globe, and that's true for emerging markets as well as for advanced economies, fiscal expansion came big time. And this is very interesting, I think, because I remember when I worked at the IMF, right, in Washington, DC. You know, IMF, the acronym, what it stands for? It's not International Monetary Fund. It's mostly fiscal. Because whenever the IMF comes to a country trying to come up with a solution, I would say fiscal, right? Fiscal accounts, have to tighten the fiscal accounts. Now, with COVID, for the first time ever, in my lifetime at least, I see the fund saying, you know what, it's time to spend like crazy, which is unusual, very unusual. Because even the IMF realized that this is an external shock, and the right answer to the external shock is to provide a lot of monetary easing, meaning you cut rates a lot, and also fiscal easing. And that's what governments did around the globe, both in advanced economies and emerging markets, and that's why the debt shot up as a share of GDP. So hopefully it now stabilizes in coming years, but it stabilizes at very high levels. I think it's going to be a challenge for emerging markets in coming years, how to deal with this higher stock of debt. For advanced economies, it's relatively easier to roll over, to refinance the debt. And the numbers are much higher, by the way, for advanced economies, right? For the US, for even the Eurozone, for Japan, the numbers are more than 100% GDP. But their credibility is much higher as well. And also they can fund themselves in hard currency, right? The US can just issue dollars. Emerging markets cannot. So this will be an issue for coming years. And I think one challenge for everyone, but especially for emerging markets, is the asymmetric nature of increases in spending. Let me explain. I mean, when you push spending, if you increase spending during a crisis, it's very easy politically, right, to spend more. Everybody likes more spending. But when the crisis passes and you have to reduce spending, it's very, very hard. So there's this asymmetry, right? It's like a ratchet effect. It's easy to go up, but it's very hard to come down. I mean, let me put it this way. Few things are as permanent as a temporary increase in fiscal spending. So politically speaking, it's not going to be easy to put the fiscal accounts back in order. And then this chart here on the right illustrates, I think, how emerging markets have a lot to do with commodities. Many emerging markets are producers, exporters of commodities. So when commodity prices go up, this actually helps a lot for the fiscal accounts and also for the external accounts. So here in this chart, on this axis, we see the impact from each 10% increase in commodity prices as percentage points of GDP. And here on the vertical axis, we show the picture for the current account, if it's a surplus of or a deficit. So in other words, I mean, if you are here in this region, your current account is in good shape, you have a surplus. basically, I'm oversimplifying. Basically, you export more than import. You have a surplus on the external accounts. And if you're here, also, it means that you're very sensitive to commodity prices. So if oil prices go up, it's great. If you're an exporter of oil, like Saudi or Russia or UAE, it's wonderful. You have a surplus already in external accounts, and you have a boost coming from oil, you're in great shape. And I can come back to that in a second when we talk in the Q&A about the implications of the current Russia-Ukraine situation, if somebody asks that question. Just a hint, maybe somebody asks that. But you see, a lot depends on where you are in this spectrum. If you are here on the left, like if you're Turkey or Romania or Egypt, you already are below the zero line here, so you already have a deficit in your external accounts, and you import a lot of oil. So if you are here and oil prices are going up, it's not good news. So I think my point here is that there is a lot of differentiation within emerging markets. I mean, we talk about emerging markets like one single block, but if you really think about it, it's a very diverse group of countries. I mean, you have Turkey, and you have Saudi Arabia, and you have South Korea, and you have Chile. Very, very different countries with some common factors, true, but with a lot of differentiation as well. Okay, let me move on. Oh, that's it? Oh, that's it. Okay, I'm done. So, questions?
Yeah, we can have a Q&A session.
Okay,
And,
sure. Take a seat there. I'll take one here.
So my first question would be, we saw how interest rates are likely to go up in emerging markets before the Fed is likely to raise interest rates. What effect do you think a higher interest rate in America would be on interest rate policy in emerging markets? Surely that would cause interest rates to be jacked up even more.
I think it's a great question because I have an answer for that. So I never have an answer, I like the question. And we just actually, in our department, we produced the econometric analysis. For those that are studying econometrics, we've done an impulse response function. So it's a VAR. I see some nodding. So vector autoregressive regression, which produces an impulse response function. I mean, translating to English, it means we try to measure how the central banks in emerging markets respond to a hike by the Fed. Look at what they did in the past. And the interesting answer is that, I mean, first of all, pretty much everyone is sensitive to some degree, right? You cannot just ignore the Fed in general, on average. But more interesting is the second part of the answer, which is it varies a lot within emerging markets. So if you are an open economy close to the US, like Mexico, you're very, very sensitive. So we do think that the Banxico, which is the Central Bank of Mexico, is going to hike rates much more than people think. They have been hiking already, by the way, but there's more to come. And that's the type of analysis that we do to come up with market recommendations and trade ideas, right? So you can play the markets by being long, being short, by playing the shape of the curve, should be steeper, should be flatter. So essentially, we recommend the trade idea that the central bank will be hiking interest rates more than the markets are pricing in. If you're right, it's a profitable trade idea. But coming back to your point, so in our study, Latin America is more sensitive to the Fed. Asia is less sensitive to the Fed. CEMEA countries are in between. To throw a few names here, so Mexico, I mentioned already, it's the most sensitive one. Understandably, right? Because Mexico is so close to the United States, it's almost like the 51st state of the United States, right? If this is being, we have a recording, right? Maybe we should strike it from the record. I think it's fair to say, indeed, I mean, Mexico is very, very exposed to the United States because of the linkages, right? Financial linkages, commercial linkages, and so on. So Mexico is very exposed. Colombia comes next. Interesting. Colombia is worth watching because Colombia has what the economists call the twin deficits, fiscal deficit and also a current account deficit. So, and that's even though Colombia is a major producer and exporter of oil. So even though oil prices are high, I mean, we're close to $100 per barrel on the Brent price. Despite the high oil prices, Colombia has a deficit on fiscal and current account, which means that it's really something that has to be sorted out. So if the Fed hikes interest rates, what you tend to see is that the US becomes a more interesting destination, right? So in terms of capital flows, they tend to be less favorable for emerging markets in general if the Fed's hiking rates. That's the logic, right? So Mexico is very affected, Colombia as well to some degree. In the CEMEA region, South Africa is quite sensitive as well. They have just started hiking rates. They started last year. There are many more hikes, I think, in South Africa to come out throughout the year, this year. And that could be reinforced by the Fed hikes. Now, if you go all the way to Asia, Asia is very insensitive to Fed hikes. I mean, geographically very far, economically not as sensitive. And actually, in places like China, we see rate cuts. We think China is actually going to ease monetary policy this year, bucking the global trend. For domestic reasons, the inflation in China is not so much of a problem. China is facing its own domestic problems. There are issues with the property sector. There are issues, more broadly speaking, with the structural forces, the economy that have been leading to a slowdown, more intense, put this way, that the authorities would look for. So despite the Fed hiking cycle, places like China actually will be going in the other direction. So to answer your question, the Fed hiking cycle puts pressures on emerging market central banks, but that varies a lot across regions and across countries within EM.
So you mentioned how China was, well, some parts of Asia were largely immune to the federal decisions, but trade between China and Western nations has hit, well, it ballooned during the pandemic as we demanded more of their goods. And we also saw towards the latter stages of last year, a huge increase in shipping costs. Why has Asia been immune to inflation?
Right, you touched several interesting points in your question. Let me address some of them. One question is, why is inflation in Asia in general, China in particular, lower than elsewhere? I think it has to do with several factors, as usual. One factor has to do with the so-called output gap. I mean, this is a jargon that economists use to try to say how much slack is there in the economy, right? How much slack is there in labor markets? How much below your potential the economy is, right? So if the economy is running well below potential, there's a big recession, and you have a lot of idle capacity in the economy, pressures on inflation tend to be less. And that's the case in Asia. I mean, Asia was growing very fast, then the crisis hit, and they never recovered to their potential as fast as has been the case in elsewhere. By contrast, for instance, if you look at the United States, I mean, the signs are very clear in my mind that this is an economy which is overheating. And look at labor markets, the employment rate is low, and if you look at all indicators like wages are growing fast. If you look at all the indicators like the quits data, I mean, which show how much people are willing to quit their job to look for another job. I mean, if you only quit your job if you're reasonably sure that you find something else, right? Otherwise, you don't. And that number is jumping very high, very fast. So in the United States, you have an overheating economy. In Asia, that's not the case. So that's the explanation number one, why inflation in China or in Asia is not so high. The other explanation, I think, has to do with the role of, I mean, consumption patterns, particularly in food. In Asia in general, I mean, the consumption of rice as a basic staple is bigger, right, than it is in the West. and rice is locally, domestically produced, and therefore less sensitive to the very big pressure you see in global food prices, in things like soybean or wheat or other. So that's another explanation. The third explanation, I think, has to do with subsidies, particularly in emerging Asia, like Thailand, Indonesia, Malaysia. The government gives a lot of subsidies to the consumption of fuel, like oil, and food as well. So if oil prices go up, it hits inflation in Latin America, for instance, because you pay more to fill up the tank. But in places like Indonesia or Malaysia, it doesn't translate into inflation pressures. To the contrary, it translates into fiscal pressures, because the government has to give bigger subsidy to keep the same price at the pump. So therefore, at least three reasons here: the output gap, the role of food in the consumption basket, and the role of subsidies. All these together help to explain why inflation in Asia is relatively lower. And also, there's the policy credibility, at least within emerging markets. I think it's fair to say Asian central banks have had better credibility, their policies. And therefore, when you see inflation pressures, these pressures are less likely to contaminate inflation expectations in Asia than it's the case, for instance, in Latin America.
Okay, so this will be my last question before anyone else can chip in. But when we're talking about credibility, we note that several Asian central banks have been, since the 1990s, really building up their foreign exchange reserves. Do you think, given how it's really hard to just build up foreign exchange reserves for some countries in Latin America, like Argentina, do you think that the best policy as of today would be to increase their credibility by increasing interest rates hard and fast, given the effect on their economy?
Okay, well, so again, several interesting aspects in your question here. So the accumulation of foreign reserves, should they hike interest rates, and what about the shape of the economy? So let me see if I can remember all of them and answer them. So on foreign reserves, it is true indeed that the external accounts of emerging markets are in much better shape today than in the past. In part because they have much more reserves. So if there's an external shock, they have more ammunition to intervene in foreign exchange markets and sell dollars, therefore contain the depreciation of the currency. And that's true across the board in emerging markets to varying degrees, but everybody has accumulated reserves over the last decade or so, which is good. The second thing which is good in the external accounts is that most countries have now a current account balance, which is better today than before. I mean, we have few economies which have large current account deficits. Some of them do, like Colombia that I mentioned, but by and large, the current account balances are in better shape today than before. So that helps. Now, the other part of your question, should then central banks hike interest rates to fight external shock? I think the answer is yes, not so much because of the external shock, but because of the domestic pressures on inflation. Now, it is true that domestic pressures on inflation can be magnified if you have a weaker currency. So if the Fed is hiking interest rates, and if that leads to a stronger dollar, therefore a weaker currency in emerging markets, but a weaker currency usually in emerging markets feed into inflation because the price of imported goods go up. It depends on the type of imported good. If it's oil, for instance, it's widely used in the economy. So you have pressures on inflation. So be because of external pressures or domestic pressures, if the inflation outlook is worsening, then yes, central banks should be hiking interest rates. Now, there are side effects, which is the third part of your question. What about the economy? Well, the economy has to slow down. And I mean, central banks don't like admitting it, right? I mean, I was just watching the other day a press interview with Jerome Powell, right? They have the governor of the Fed. And he was asking, oh, is this a policy mistake? Are you overkilling the economy? Is there a risk of recession down the road? Well, I'm sorry to tell you this, but the fact is that if you look at the US history of the last few decades, US recessions are often preceded by a Fed tightening cycle. I mean, not necessarily the case that whenever the Fed hikes, necessarily you have to have a big recession, but there is some correlation. The correlation is not causation, we know, my point is, if you tighten monetary policy, something has to give. You have to cool down the economy. Okay, maybe not a recession, but it has to have some implication for growth, for jobs, which is needed, right? I mean, no central bank does this because they're mean or they're bad guys. They just want to make sure that inflation is under control, and for that you have to cool down the labor market, have to cool down growth, and that's actually important to sustain, to promote long-term growth. I can tell you this coming from Latin America. High inflation does not buy you growth for too long. It's a myth, it's an illusion to think that you can boost growth sustainably by letting inflation run high. I mean, at the end of the day, you end up with the worst case possible, which is stagflation. I've seen it in Brazil, I've seen it in Latin America. On and on again, you have, at the end of the day, this terrible situation of recession and inflation at the same time. So my advice for central banks, if they're watching, is don't let inflation get out of control. I mean, the medicine is bitter. Hiking interest rates will cool down the economy, but in the long run, it's good for you. It's like going to the gym. You may not like it today, but in the long run, it's good for you. And if you go to the gym like in this building, it's great. Great.
If anyone else has questions, yeah.
Okay. So thank you so much for your enlivening talk, Marcelo. So similar to what you just touched on, there was Lord Mervyn King. I went to his lecture in November, and at that time there was this transitory persistent debate going on. So at that point, he said that technocrats have this foolish tendency to be precisely wrong rather than be roughly right. And he was saying this in the context of the things you mentioned, such as inflation targeting, forward guidance, quantitative easing. And even though he was the one who was the governor under the recession, GFC, he brought these measures, some of them, QE, into place in UK. But I would like to hear from you that there was a point on monetary aggregates, that central banks today in the developed, in the advanced economies, some don't even publish, don't even look at monetary aggregates as such. Do you think it's the same case for emerging markets, or do monetary aggregates have any value as indicators to dictate policy in emerging markets?
I would say that we should probably look at everything, including monetary aggregates, that often get overlooked. But I think you can look at them and find some correlations, and they tend to illustrate that indeed, the stronger the monetary base grows, the more likely you're going to see inflation. So there's some correlation there. I mean, it was Friedman that said, right? Inflation is always and everywhere monetary phenomenon, right? So we need to watch monetary aggregates as well. That being said, I have also to say that the difficulty in looking at the supply side of monetary aggregates is that the demand side is very volatile. I mean, demand for money, you can look at the supply of money, but the demand for money can be very volatile. I mean, look at COVID, right? Demand for money, for cash balances, it has been all over the place. And I would say maybe even more so in emerging markets, the volatility than in domestic economies. So therefore, the relationship between monetary aggregates and inflation, maybe it's not as stable as you'd look for, as you would wish, right? So watch it. My advice is therefore watch it, but with a grain of salt. The other thing I wanted to comment, you mentioned forward guidance. And I mean, I smile when I think about forward guidance, because I mean, when I look at the Fed, for instance, right? Let me tell you this. The Fed has a target of 2% inflation. So for many years, they couldn't reach it because inflation was running too low. So the Fed really feared the possibility of becoming Japan, right? Of deflation. If you're stuck with very low inflation or even deflation, it's a problem for a central bank, right? Because, I mean, these guys know what to do when inflation is high. You hike interest rates, they've done it before, they will do it again. When you have deflation, it's a bigger problem. Like in Japan today, even today, Japan is still stuck with low growth, low inflation. How do you get out of that? So that was the Fed's fear a couple of years ago, before COVID. And that's why they came up with this brilliant idea of flexible average inflation targeting, right? Which basically said, well, rather than 2%, let's look at average inflation over time. Meaning that if inflation has been running below 2%, which has been the case for many years in the US, we, the Fed, will be happy in allowing inflation to run above 2% for quite a while. So on average, it's about 2%. So this is quite a change, because in the previous inflation target regime, if inflation is running above 2%, they would hike rates. Now they're saying, I'm happy to let inflation run hot, the economy run hot, inflation run above 2%, and I won't hike. I'll be very slow, right, in hiking. I'll be very accommodative. And they have been, over the last year or so, inflation has been pointing upwards, and they were not hiking, unlike they would do in the past. Economists come up with these rules. One of them is the so-called Taylor rule, right? John Taylor was the guy that came up with this very simple equation showing that the interest rate should adjust according to the deviation from the inflation target and the deviation from potential growth. Right? So if the economy is overheating, inflation is high, you hike interest rates. That's basically the idea. Now, if you look at the Taylor rule for the United States, the Fed should have hiked rates already long ago. They didn't. And they promised us that they wouldn't do it. The problem, I think, with that kind of forward guidance, right, rather than following a rule, they say, look, I'm not going to hike rates. Maybe even if the model says I should, I won't. Because I want to make sure that we avoid the risk of deflation. I want to make sure that I bring inflation expectations up. The problem is, be careful what we wish for. Because if you wanted to have more inflation, well, now you have more inflation, but maybe now you have too much of it. I mean, if the target is 2%, 3% is okay, but you don't have 4 or 5 or even 6, now you have 7.5. That's why you end up with this picture of gradually and then suddenly, right? They were stuck at the bottom for a long period of time, but now they have to rush and hike rates in coming several months in order to contain inflation pressures and bring them back to the 2% target. So this is a long explanation just to make the point that the forward guidance may sound on paper like a bright idea, but in practice, there are complications.
Thank you so much.
And then just make a comment too, because you asked about whether monetary aggregates are relevant to EM or not. And I mean, of course they are. It's part of job of the central bank to watch every and single monetary aggregate, have departments just looking at that, probably incredibly boring job, but it's there and it's extremely relevant. But at the same time, when you're talking about communicating monetary policy, particularly in an emerging market context, and when we are sitting here in London, it's important to bear in mind the differences, because here where I have established central banking for extreme long period of time, the media, people, they tend to believe what the central bank says. Well, in many, even major emerging markets, that's not the case. Or if the central bank sometimes clashes with the governments and so on and so forth. So sometimes simplicity is important. So that's why Marcelo in one of the slides was talking about inflation targeting. And just to see so many emerging market central bankers using inflation targets and following them and using that as a guide for their decisions, which tend to be, at least in front of the people, mean changes in interest rates. This is already a big achievement, right? And it is more important sometimes to focus on that simple things, particularly when you are communicating or you're dealing with policy, in order for the policy to be effective. Because in many cases, you still have to establish and make that first part of monetary policy credible in order to, go to the next step, be it quantitative easing or micromanagement of monetary aggregates. And there's a second step also in central banking, particularly when we don't have enough autonomy, which is when you try to do something more sophisticated, at the end of the day, as we watched several times, it's just an excuse not to increase interest rates. We saw that in Argentina, for example, when they started actually not having inflation targets anymore because they were never reaching their inflation targets, and people didn't believe the central bank could ever achieve inflation targets, and unfortunately that's still the case. And they started targeting growth in monetary aggregates. That did not work. There was clashes from the government when the central bank started to increase interest rates, and then they're like trying to make excuses not to increase interest rates by, looking at the nuances in monetary aggregates, which at the end of the day was just rubbish, and an excuse not to, do the proper job and put a damper in economic growth as back then Argentina needed to.
Thanks.
Any other questions? Yeah.
So my question is on emerging market debt. So if you see last year, there were a lot of downgrades for a lot of emerging markets, and you see a lot of countries even defaulted. So Lebanon defaulted, Zambia, Ecuador, they all defaulted. And currently, if you look at Sri Lanka, a lot of people are saying it's a 50-50 call that it might just default on its debt. So investors at the end of the day look at a risk return profile. And as you even said that if interest rates rise in the US, which they will, the dollar will rise, and that will make hard currency denominated debt, which a lot of countries have taken harder to service. So from a risk return profile, what do you think about emerging market debt? Is the risk too high to essentially take that down?
I think the answer depends on the country, it depends on the specific numbers. But let me say this, the debt dynamics depend on the, of course, numerator and the denominator, the ratio of the debt as a share of GDP, right? So when you look at the denominator, GDP means that the faster the economy grows, the better shape you are, right, to sustain fiscal expansion. If, however, for whatever reason, structurally potential growth is coming down, then it's a complication. Hence, the typical policy recommendation that if you can adopt measures that boost your potential growth, that's the way to go, right? I think the best fiscal solution is actually growth, sustainable growth, of course, not just short term. Then you look at the numerator of the debt. The debt is driven by the primary surpluses or deficits that you have, the so-called primary ones, excluding the burden of interest payments. And then the debt is also driven by the servicing of the debt, right? The interest payments on the debt. And the interest payments, they have two components. They have the internal interest payments and have the external interest payments. And the external interest payments, if your debt is in foreign currency, they are sensitive to the exchange rate. I mean, if you're an emerging market country, you have a lot of dollar debt, right, international markets. If the dollar appreciates, your currency devalues, well, your dollar is more expensive now, right? So the currency move can hurt or help in the debt picture. The good news, however, is that many countries have reduced the so-called original sin. Original sin is a term that economists use to refer to the emerging markets' historical difficulty to issue debt in local currency. It's much easier to issue in foreign currency. I mean, if you're a foreign investor, you're more likely to buy some instrument which guarantees you a return in hard currency than a local currency debt, right? So that's what the original sin is all about. The difficulty of emerging markets to issue debt locally, they issue the external debt. If, however, you can reduce that original sin by issuing more in local currency, you're less exposed to a currency depreciation. So the good news is that the emerging markets have been able over time to issue relatively more in local currency debt than in external hard currency terms. So that helps. That makes them less sensitive to currency devaluation. But less sensitive doesn't mean immune. So it's still, there's a currency component there. Another component is the interest rate itself. If you have an external debt or domestic debt that pays a certain interest rate, if that interest rate goes up, well, it's not good news. And we just came to the conclusion here that the Fed is going to hike interest rates. So global interest rates are going up. And I just told you that emerging markets are hiking their own policy rates. So be it external debt or be it domestic debt, the burden of interest payment is going up, which means that either you have to grow faster sustainably, which would be ideal, but not easy, or else you cannot run primary deficits as large as before. You have to tighten your fiscal belt, so to speak, to maintain the debt GDP level. So it's a very long explanation to come to the conclusion that an increase in interest rates is not good news for the debt sustainability in emerging markets.
Hi, thank you for your presentation. I was wondering if you could talk more about the context in Brazil, especially the political situation and how it changes, and kind of also to do with like the environment as well. I think that could be quite a big thing.
Wow. I say wow because do you have a few hours too? I happen to be Brazilian, and Luis I brought from Brazil as well, and I brought my son Alex, who is here. He's from Brazil as well. He's also a student. Not LSE, nothing is perfect, but I wanted him to be here, but he said, Dad, I don't want to live in the same city as you, so I'm going to another city. Maybe he comes back to the masters here at LSE. I don't need to put him on the spot, sorry about that. But coming back to your point, Brazil. The political situation is complicated because we have elections this year. So the current president is Bolsonaro. I know I've been recorded, so let me be careful with my words. But his policies have been questionable, let me put it this way. And we're going to see presidential elections this year. So elections are in October, 2 terms. So the 2 main contenders today are Mr. Bolsonaro, the current president. If he wins, is more of the same, essentially. And the main opposition candidate is Lula, Luiz Inácio Lula da Silva, former president of Brazil for 2 terms, coming from the left, right? He's a candidate from the Workers' Party. So Luis is very keen talking about politics, but he'll be talking for hours. So let me give the short answer here. So we have uncertainty in Brazil today, as usual, when you have elections, because you don't know who is going to win. If it's Bolsonaro, again, it's more of the same. If it's Lula, there is uncertainty how a Lula administration would look like. I have to say the downside and the upside. The downside is that, well, it's a left-wing administration. Usually, if the left comes to power, you'd normally expect more fiscal spending. Brazil cannot really afford much more spending. Is this a market-friendly government or not? So that's a kind of issue that comes to mind in general. In the specific case of Lula, those concerns turned out to be misplaced back in 2003 when he was elected, and actually delivered an administration which was incredibly market-friendly, much more so than markets feared initially. It was great. Now, I have to say also, it was great in a very favorable international context. From 2003 until at least 2008, briefly commodity prices came down, but then they went up again. I mean, the global environment was incredibly helpful for commodity exporting countries like Brazil. Commodity prices were booming. So Lula inherited back then a very favorable global environment. And to his merit, he didn't just waste it. I mean, we had reasonably good policies, market-friendly policies during his first administration. Second administration is questionable. And then his successor, I mean, it's fair to say his successor administration was widely seen as a disaster, to be frank. It was bad. It ended in impeachment at the end of the day. So which kind of Lula we're going to see if he is elected is a question mark for Brazil. But I do think that whoever wins the elections, the really deeper structural issue here, which at the end of the day is political one, is how do you handle the fiscal accounts in a political situation where the social needs are very high, but the budget doesn't really accommodate the necessary spending in light of the pressures that you have on revenues and on spending. Let me elaborate very briefly. On revenues, the tax burden in Brazil is already very high, like 35% GDP, which is high by emerging market standards. I mean, Brazil taxes like Sweden or Norway, but I can assure you don't have Norwegian teachers, Brazil, or Swedish nurses, or so there's a discrepancy between the tax burden, which is very high, and the quality of the services, which is very low. And on the spending side, a lot of the spending in Brazil is earmarked. I mean, there's little discretion. So we spend a lot with pensions, we spend a lot with payroll in the public sector, and there is little left for the really socially important spending, right, on items that matter most for the poor. So you need the structural reforms. That's the bottom line. You need structural reforms to review the priorities on spending in Brazil. I think that's the way to go, but that's politically very difficult. Whoever wins, therefore, the elections, we have a very important challenge going forward, particularly to make sure that the fiscal accounts are in better shape. Is that a good summary?
Yeah, I was just add also that you said that the fear with Lula is that whether he will be market friendly or not. And the thing about Bolsonaro is that although at the start, right before he was elected during the campaign, he was seen, particularly in the second round, as the market friendly candidate, and he wasn't. The reality is that Brazil has embarked, particularly in these past 2 years, into a flurry of fiscal populism that has gone worse in this past few months. So actually, when we talk to investors, the perception sometimes, not rarely, is more negative towards Bolsonaro than Lula, because besides all the fiscal populism, we're also talking about risks to institutions, to the democratic fabric of the country, and so on and so forth. And if there's one thing that investors do not like, is uncertainty, right? And you have a proper far-right populist in power. So, you know, all in all, I mean, until the election, we're going to have quite the bumpy ride, I think.
So you can tell that we have strong views about politics in Brazil. Maybe I wouldn't go that far in the wording, but yes, those are the issues.
Two more questions, roughly.
Yeah, so like thank you for the insightful presentation, by the way. And if you could just give an overview on the Russia-Ukraine tensions that's rising, building up right now, and its impact, because like as we had a lot of discussion on inflation as well, so it's gonna have a lot of impact on inflation in terms of the oil pricing and everything. So like what sort of outlook, or like how will it affect emerging markets in the long term?
Oh yeah, great question. I'm actually surprised that we came this far without talking about Russia-Ukraine in this talk so far. But I mean, first thing we have to say, of course, is that there's a lot of uncertainty. Nobody really knows what's going to be happening tomorrow or next week or next month. But I think it's fair to say the uncertainty is likely going to be here to stay. I doubt that this is something that will be sorted out overnight. It won't, right? The uncertainty is going to be there. On both sides of the equation, meaning what is Russia going to do, and also on what the response is going to be by the West, right? By the West and the European countries and so on. Now, let me tell you this to answer your question. When I think about the impact to emerging markets, I see three channels, transmission channels. If things escalate, the three channels would be what happens to risk premium, what happens to inflation, and what happens to terms of trade. Let me explain. So what happens to risk premium first? I think the idea is simple. I mean, if you have conflict, you have escalation, typically the premium that investors require for the investments, it goes up. So risky assets like emerging markets, considered more risky, tend not to do well in that type of environment. It's a flight to safety kind of environment, right? If things are bumpy, you hold on to what you consider to be safer, you go to the safe haven, so to speak, which is usually US treasuries, right? The dollar tends to appreciate, the treasuries do well, and risky assets like emerging markets don't tend to do that well. So that's one first transmission channel. The second transmission channel is inflation. And that's a very important one, and I think it's going to happen. And that means upward pressures on oil prices and upward pressures on food prices globally. On oil is obvious, right? Oil is already high. and could go even higher if you have difficulties related to Russian exports. I mean, Russia is a big exporter of oil, as you know, so this matters a lot. The other inflationary pressure, which is maybe less visible, but very important too, is food prices. Let's keep in mind that Russia is a very important global exporter of wheat. Russia is also a very important exporter of chemicals that are used as fertilizers. So you need fertilizers to produce food, right? I mean, if you're in Brazil, for instance, you are a farmer, you need fertilizers, which are imported to produce soybean, which then are used as feed into chicken, for instance. I mean, some people say that chicken is just processed corn. In a sense, it is, right? But you see my point. If you see pressure on prices for fertilizers, you have pressures on prices for feed, you have pressures on prices for protein, animal protein. So the whole food chain gets impacted by the potential escalation of the situation in Russia, Ukraine. So it's more than just oil, therefore. So either way, because of oil prices, because of food prices, I think we're likely to see in this scenario of escalation further upward pressures on global inflation, everywhere, by the way. But particularly for emerging markets, because in emerging markets, the role of food is bigger. If you look at the CPI basket, I mean, CPI is Consumer Price Index, right? The basket of what people consume. In emerging markets, food is like 20, 25, 30% of the basket, because average incomes are typically lower, right? For advanced economies, this number is much less, like 10%, 15% at most. I mean, it's intuitive, right? The richer you are, the less you spend on food, right? You get, I mean, you can spend only so much on food, right? I mean, unless you live in London where food prices are, but you get my point. So, so this is the second channel, right? Food prices along with oil means that inflationary pressures would build. The third channel is terms of trade. By that I mean when commodity prices are going up, like oil prices again, there are winners and losers within emerging markets. If you're an oil exporting country like those in the GCC, or even Russia, right? Ironically, or Colombia, or some countries in Asia, Malaysia, or Indonesia, you're benefiting from an increase in prices of the stuff that you export. Or even for food, if you're a soybean exporter, like Argentina or Brazil, it's good for external accounts that prices are going up. However, if you're importing that stuff, it's bad news. If you're India, or if you're Turkey, or many other places that are importers of oil or food in general, it's bad news that those prices are going up. So in summary, if there is an escalation, we are going to see risk premium going up. You are going to see further pressures on global inflation, and you have shifts in the so-called terms of trade. And then it depends if you're an exporter or importer of commodities within emerging markets. Therefore, we're likely going to see winners and losers. Overall, I don't think net it's good news for emerging markets. And I see it's 7:15 already. So, oh my God, you're really brave. You're staying here for quite a while. We should be wrapping up soon, I guess. Maybe one last question. And let me also say, I brought along Nicolo, who works with me. He is a recent graduate. Again, unfortunately not LSE. Nobody's perfect.
I'm so sorry.
But maybe, you still have the masters, okay. But maybe he can share perhaps a few comments about how it is working for a place like BNP. If you're a recent graduate, your students here, if you think about your career, he can tell how wonderful it is to work for people like me and work for a place like BNP. But before I do that, maybe there's one last question, perhaps, or maybe not. Not, yeah, okay.
I wanted to ask one. So you mentioned multiple times there's a sort of distrust and lack of confidence between policy institutions like the central bank and the people. And correct me if I'm wrong, but this creates a sort of vicious cycle where because of the lack of confidence, it's hard to get good policies working. And because of that, there's less trust in the institutions. How exactly can this cycle be broken and how can confidence be built?
With difficulty.
Yeah.
Is the answer. But I mean, seriously, I think it takes leadership. And I don't think that vicious cycles can never be broken. They can be broken. I mean, you can think of, again, places like Brazil, which I know best, right? Because I'm from there. We will had hyperinflation, as I mentioned, in the 80s into the 90s. And you had, I think, a very strong and favorable positive leadership when Fernando Henrique Cardoso got elected in Brazil. And we launched the so-called HELP plan. I mean, he was the finance minister first, but we did have a shift in policy that had the backing, political backing of the population, because everyone was fed up with inflation, hyperinflation really. And then we had a leadership that came to power and managed to change the policy framework in the right direction, right? Of a much more credible central bank with much lower inflation, a credible stabilization plan. So you need, first of all, leadership. So it does require the political backing, right? It's not just leadership out of the blue, right? Of course, you have to have the political social conditions that support that leadership, but you have to have the leadership itself, right? You have to have both, I think. On top of that, I mean, you get the ball rolling with the leadership, but you need to have sustainability over time. Persistency, maybe is the word here. That it goes beyond just one administration. It's really a broader, a broader understanding the society at large, that this is the path to go. And if that goes beyond just one administration, that's the path to sustainability, to lasting credibility. In other words, you have to really make sure that the right institutions are in place. And the trick, of course, is that institutions take time to really build and can be destroyed very quickly. Central bank credibility, for instance, is one good example. I mean, you go up taking the staircase, but you go down taking the elevator. Hard to build, easy to destroy. So in emerging markets, I think the best that you can do as a policymaker is to make sure not just you have the short-term good management of the economy or the markets, but that you have this effort to build long-lasting credibility, long-lasting institutions that stay for the long term. Easier said than done, but that's the way to go.
Thank you.
On that note, those are great words. I'm really proud of speaking here. But let me stop on that good note, and maybe you can hear from Nicolo about how it is working for BNP.
Yes, no, sure. I'm aware of time, so I'll keep it quick. But I was hoping to give you a quick overview of what it has been like for me since I joined the bank. I started working from BNP mid-September, and also I'll try to keep it, asset class, general, also general in region. But I will probably tilt the discussion a bit towards research, which is my stream within the grad program. And I feel like I've been quite lucky because I joined the bank in quite a peculiar historical juncture. And what I mean by that is, I mean, you see it from the, the breadth of arguments that you guys correctly brought up, right? So, for example, when I joined, I remember that a big theme was the inflation saga, right? Whether that was, say, temporary or whether you thought that inflation was there to stay. And I remember that things back then changed on a daily basis, right? So once you had some very important person reassuring markets that inflation would, eventually go away, so that then relaxed all the fears of, say, a policy mistake that Marcelo mentioned before. And then, end November came Omicron, right? And that was a completely different news flow, which changed perhaps the direction of the debate, right? Because if you have an uncertain situation, which is perhaps is going to pose a downward threat to growth, then the argument of the policy mistake gains even more traction and becomes relevant once again, right? And we still probably don't know the answer to that, although the Russian-Ukraine situation helps to answer the question because of the inflationary repercussions that Marcelo mentioned. But I wanted to mention that just an idea of how things quickly change, and now you are really unlikely to have a permanent answer to a big macro story like that one. And so yeah, the one thing that I noticed is the big positive for me is the exposure, which I found insane, to be honest with you, and how I realized how much exposed I was to the macro themes, the inflation, the interest rate stories, the central banks, and all of that. It was by reading say publicly available information, right? So I was used to reading, for example, the Financial Times a lot, right? Even before starting to work. But when you get back into that, and by the way, I have nothing against the Financial Times, I think it's great. When you get back into that and you start reading some pieces, you start to see gaps, right? Gaps in between paragraphs, and you also start to realize that you are ahead of the game, right? Not by a year or so, but by a few steps. I mean, for example, I remember reading last week, there was an article on emerging markets, and as you guys also mentioned, the big risks, right? Because the growth differential between emerging markets and developed economies, which is, some would argue, the main reason for investing into those countries, they were arguing how the differential was shrinking, right? And I was reading into that and thinking, wait a second, we had we published our global outlook at the end of 2021, and we already were addressing all those sorts of issues, right? So you realize how it's nice to be not only to see gaps in news flow, but also to be ahead of them. And also I feel like it has been very helpful to me to having come out of university recently, last year in fact. It's very helpful. It helps you to bridge the gap between theory and practice, right? I mean, if I could give you one of the latest examples, is that the other day, in fact, I think it was yesterday, we were hearing from a representative from the Central Bank of Russia, right? And one of the things that I've taken away from university, studying macroeconomics, is that when the yield curve either inverts or flattens, normally that's a sign to a recession, right? And we were hearing how they interpret it in Russia is nothing like that, right? They see the low inflation embedded into the yield curve as a sign of monetary policy credibility, right? Rather than recession. So that's just a stupid example, one of the latest example of how sometimes you walk into work with a few things, with a few ideas, with a few theories that you accumulated in university, and you get proven wrong. But that's exactly the point. I mean, the more you start to grasp the difference between theory and practice, the more you're gonna get closer to practice. And that was one example. What else I can say? I think Marcelo, I'll stop here.
Okay.
Yeah.
Thank you, Nicola.
No
Thank you,
problem.
Marcelo.
Sure. If there are no more questions, then let me say a big thank you. It's really a pleasure to be here. This was fun. Let's do it again, maybe 1 or 2 years from now, to see how long I was, my predictions. But otherwise, really a pleasure. Thank you very much for the invitation. Thank you. You're free to go now.